The tax code does not reward effort, it rewards classification. That is one of the ugliest and most useful truths in all of personal finance. Most people imagine taxes as a moral system. Work hard, earn money, pay your share, try to be responsible, and maybe, if you are lucky, you will keep enough of what is left to build a life. That is how employees are trained to think. It is how schools teach it, how payroll systems reinforce it, and how most households live without ever naming the trap. You earn first, you get taxed next, you live on what remains. That is the default operating system of the ordinary person. And it is precisely why ordinary people feel like they are running uphill with sandbags on their ankles. The people who build serious wealth do not merely earn more. Sometimes they do, sometimes they do not. What they do more consistently is something much less romantic. They understand how the tax system decides what counts as personal consumption, what counts as business expense, what counts as deductible health cost, what counts as investment expense, what counts as employee benefit, and what counts as a legitimate reduction of taxable income before the government ever gets to put a hand into the bucket. That is the real game. Not tax evasion, not fantasies about writing off your whole life, not internet nonsense about turning every lunch, every car, and every family vacation into a deduction with one magic LLC. I have no patience for that kind of foolishness. What I am talking about is much more important and much more disciplined. I am talking about understanding the rules well enough that you stop volunteering more taxable income than the law actually requires. That sounds simple. It is not. The reason it is not simple is that most people have been taught the wrong mental model. They think the tax system asks one big question: what did you earn? In practice, it asks a more subtle question first: what was the nature of the money and what was the nature of the expense? That distinction creates fortunes. Let me put it as plainly as I can. If you earn $10 as a wage earner, the system is built to treat almost all 10 as taxable before your life begins. If you earn $10 in a real trade or business, then a new door opens. The question is no longer only what you earned. The question becomes what ordinary and necessary costs were incurred in generating that income, maintaining the business, serving customers, housing the operation, moving yourself to the work, insuring yourself, training the people who help you, and supporting the legitimate infrastructure of the activity. That door is where the wealthy live. Not because they are smarter than everyone else, because they stop living entirely inside the employee operating system. This is the first mechanism. I call it the sequence flip. The sequence flip is when you move from a world where money becomes taxable first and useful second into a world where certain legitimate expenses are recognized before the tax bite is finalized. That does not mean every expense becomes magic. It means some expenses are reclassified if and only if they truly serve the business and meet the legal standard. Under Section 162, the tax law generally allows a trade or business to deduct ordinary and necessary expenses paid or incurred in carrying on that business. That is the hinge everything swings on. Facite Fayturn 225,173 search. 0 Fayturn 225,173 search. 1 Fay, most people hear that and immediately become dangerous. They start fantasizing. They start asking the wrong question. How do I write off everything? That is the question of a future audit statistic. The right question is this: what part of my real economic life can be lawfully shifted from personal after-tax burden to business or other tax favored treatment, if the facts, structure, and documentation actually support it? That is how adults think. This is why the existence of a real trade or business matters so much. The business is not just a logo, not just a filing, not just an LLC created on a sleepy Sunday afternoon. The business is the legal and economic engine that gives certain expenses context. Context is everything. A room in your house is not automatically deductible because you think hard there. A room can become deductible when it is used regularly and, where required, exclusively for business. A meal is not deductible because you talked about ambition over pasta. A business meal deduction generally depends on actual business context, your presence, and the expense not being lavish. And even then, the deduction is generally limited to 50%. Facite Fayturn 225,173 search 2, Fayturn 225,173 search 6, Fayturn 225,173 search 18 Fay. That is why I dislike the phrase everyday expenses when people use it carelessly. It makes the tax code sound like a slot machine. It is not a slot machine. It is a classification machine. and classification machines pay for evidence. Now, once you understand the sequence flip, the next thing you need to understand is what I call the legitimacy filter. The legitimacy filter is the part most people skip because they want outcomes faster than they want structure. They hear that housing, cars, travel, education, health costs, and family-related expenses can under some circumstances be deductible or tax advantaged, and they jump straight to the result without surviving the filter. But the filter is where the law lives. Business purpose, regular use, exclusive use in some contexts, appropriate records, proper entity type when required, employee, benefit rules, ownership limitations, percentage of business use, actual trade, or busyness activity. That is where the truth is. Take the home office people here, write off part of your home and immediately become sloppy. The law is stricter than they want it to be. And for good reason, the home office deduction is not there to subsidize your couch. If the exclusive use rule applies, the relevant space generally must be used only for business, and it must be used regularly as the principal place of business, or as a place to meet clients, among other qualifying paths. There is also a simplified method, but the core principle has not changed. A mixed personal room is usually not enough. Faysite Fay turn 225,173 search 4 Fay turn 225,173 search 8 Fay turn 225,173 search 12 Fay. That sounds restrictive. Good. Restrictions are what separate lawful planning from childish wishful thinking. But once the filter is legitimately satisfied, the economics change. Now, a slice of rent mortgage, related home expense, utilities, insurance, maintenance, and other allocable home costs can begin taking on a different tax character, depending on the facts and the method used. The room did not become magical, it became classifiable. That is a very important distinction. The same logic applies to a vehicle. And this is where people get themselves into trouble with almost comic consistency. A vehicle is not deductible because it exists. A vehicle becomes deductible to the extent of qualifying business use. The IRS is explicit that if you use a car only for business, you may deduct the full cost of ownership and operation subject to applicable limits. And if the use is mixed, you deduct only the business portion. A great many write off your G-Wagon fantasies die right there. Business use is not whatever story you tell your friends. It is what you can substantiate. Faysite Fay turn 186,699 search 3 Fay turn 186,699 search 0 Fay, and then you hit the next layer of reality. Percentages, thresholds, limits, Section 179 limits, SUV caps, bonus depreciation rules, actual expense versus standard mileage choices, more than 50%, business use requirements. All of it matters. For 2026, the IRS reflects inflation, adjusted Section 179 limits and a separate SUV cap, while bonus depreciation rules continue to have their own conditions. This is why I distrust anyone speaking about vehicle write-offs in one sentence. One sentence is how people end up with very expensive misunderstandings. Faysite Fay turn 186,699 search 16 Fay turn 186,699 search 11 Fay turn 186,699 search 7 Fay. That brings us to something subtler than deductions. And in some ways even more powerful. I am talking about the entity and benefit layer. A lot of people think tax planning is about receipts. Receipts matter, structure matters more. If you are truly self-employed or operating through a real business, some expenses can move into more favorable lanes, not because you waived them at Schedule C, but because the business can sponsor arrangements the ordinary household cannot. Health reimbursement arrangements, self-employed health insurance deductions, health savings accounts, if you have qualifying coverage, educational assistance programs, dependent care assistance in the employer context, reimbursement structures, formal plans. These are not internet tricks. These are legal frameworks, and frameworks beat improvisation every time. Faysite Fay turn 225,173 search 1 Fay turn 225,173 search 3 Fay turn 225,173 search 7 Fay turn 186,699 search 2 Fay turn 186,699 search 10 Fay. Let us stay with health for a moment, because this is one of the most emotionally loaded and financially misunderstood parts of the code. The ordinary family experiences health costs as pain, premiums, deductibles, copays, specialists, therapies, tests, bills that arrive at precisely the wrong moment. Then they learn that medical expenses on the individual side usually face a 7.5% of AGI threshold and itemizing realities that mean many households receive less tax relief than they imagined. That is a nasty surprise. But once business structure and benefit arrangements enter the picture, the analysis changes self. Employed individuals may be able to deduct health insurance premiums for themselves, their spouse, and dependents, subject to the rules and income limitations. HSAs can deliver a very unusual triple benefit when you qualify: deductible contributions, tax-free growth, and tax. Free distributions for qualified medical expenses for 2026. The IRS has published adjusted HSA contribution limits and expanded some eligibility rules under recent law changes. Faysite, Fayturn 225,173 search 1, Fayturn 225,173 search 5, Fayturn 225,173 search 3, Fayturn 225,173 search 11, Fayturn 225,173 search 13, Fay. That is the third mechanism. I call it the wrapper advantage. The wrapper advantage is what happens when the expense does not merely get deducted in the ordinary personal way, but is instead housed inside a tax-favored wrapper designed by law for a specific purpose. The wrapper can be an HSA, it can be a properly structured employer-style benefit plan. It can be a reimbursement arrangement. It can be an educational assistance plan under Section 127. It can be the self-employed health insurance deduction. The point is not the acronym. The point is that the wrapper changes the tax character of the cash flow. Most people never think in wrappers. They think only in purchases. That is one reason the wealthy keep more of what they make. Now let us talk about children dependents and the point at which tax planning becomes emotionally dangerous. Few things make people sound more foolish faster than saying, "You can write off your kids." That phrase travels well on social media because it is vulgar enough to attract attention. It is also imprecise enough to create stupidity. Children are not deductions because they exist as household furniture. There are credits, dependency rules, child care rules, and in some cases, legitimate business-related avenues, but precision matters enormously. If a child or other dependent is actually doing real work for the business and is paid a reasonable wage for actual services, then yes, the business can potentially deduct compensation like it would for other labor, assuming all the normal rules are respected. If an employer-sponsored dependent care arrangement is lawfully in place, that is another framework. The child and dependent care credit exists in its own lane on the individual side. These are separate mechanisms. They are not one giant cartoon called writing off your family. Faysite, Fayturn 186,699 search 1, Fayturn 186,699 search 5, Fayturn 186,699 search 17, Fayturn 186,699 search 18, Fay. That is the fourth mechanism. I call it the family reclassification principle. The family reclassification principle is not about laundering private family support through a fake business story. It is about recognizing that the tax code contains specific paths by which family-linked expenses can change character when the underlying facts change. A child performing real business tasks is not the same as a child merely living in your house. Qualified dependent care to enable work is not the same as ordinary household life. An employee benefit plan is not the same as a parent deciding after the fact that child care felt expensive and should therefore be deductible. The facts drive the lane. Facts, not wishes. The same sobriety should be applied to education. This is another area where people become careless because the cost is so high and the emotional desire for relief is so intense. The tax law does recognize education and training in meaningful ways, but again, the purpose and structure matter. There are business education deductions in appropriate circumstances, but they are not a blanket permission slip for every degree you think sounds useful. Employer educational assistance programs under Section 127 have their own rules, their own limits, and their own ownership complications. The IRS continues to reflect the general $5,250 annual tax-free educational assistance limit under those programs. And employer-student loan assistance rules have had their own statutory time window and conditions. One sentence cannot safely capture this area. Faceit Faturn 186,699 search 2, Faturn 186,699 search 6, Faturn 186,699 search 10, Faturn 186,699 search 14, Faturn 186,699 search 9, Fa. So what do I want you to take from that? Not fear, respect for the difference between an ordinary household cost, a business training expense, and a properly structured employee benefit. The tax code is generous in some places and merciless in others. It rewards those who read the map. It wounds those who assume the map says what they want it to say. Now, let us move to meals and travel, because these are the two categories where human beings are most likely to confuse memory with documentation and desire with deductibility. I have never met a person who needed help convincing himself a dinner might have been kind of business related. That is exactly the problem. The tax law is not trying to reimburse your personality. Business meals are generally 50% deductible when the requirements are met. The business taxpayer or an employee generally needs to be present. The expense cannot be lavish or extravagant under the circumstances, and there must be the necessary business connection. Entertainment itself is generally non-deductible unless separately stated. Meals fit the applicable rules. Travel similarly lives or dies on business purpose, substantiation, and the actual facts of why you were there. Faceit Faturn 225,173 search 2, Faturn 225,173 search 6, Faturn 225,173 search 10, Faturn 225,173 search 14, Faturn 225,173 search 18, Fa. That is the fifth mechanism. I call it the narrative risk. Narrative risk is what happens when a deduction depends heavily on a story, and the story is weaker than the documents. Meals and travel are full of narrative risk because people remember the business flavor of an event more vividly than they can prove it later. They tell themselves the conference mattered, the client conversation mattered, the location scouting mattered. Maybe it did. But receipts, calendars, agendas, attendee records, contemporaneous notes, and the actual business reason matter more than memory in this arena. If you cannot bear the thought of proving the business purpose to a skeptical stranger years later, do not act as though it is a clean deduction today. You will notice that all of this sounds less exciting than the original promise. Good excitement is usually a terrible standard for tax advice. The truth is more powerful anyway. You do not need the code to be magical. You only need it to be understood. That is where the wealthy have an advantage, not because they are lawless, often because they are more system-minded. They think in entities, reimbursement paths, plan design, allocation methods, substantiation routines, timing, and record keeping. The ordinary person thinks in single expenses. The system-minded person thinks in operating systems. That is the sixth mechanism. I call it the tax operating system. A tax operating system is the set of habits, entity choices, accounts, policies, calendars, payroll logic, benefit wrappers, documentation procedures, and reimbursement practices that convert a pile of ad hoc financial life into something the tax code can actually understand and reward. Without the operating system, you have isolated deductions, occasional missed opportunities, and constant confusion. With the operating system, you begin to see your economic life the way the law sees it, by category, purpose, and structure. This is why two people with roughly the same gross income can live in financially different worlds. One is earning and then hoping. The other is structuring and then earning inside the structure. The second person often feels richer even before they are richer, because the leakage slows down. Leakage is what destroys middle-class wealth, not one giant mistake. 1,000 little post-tax payments flowing out of a system that never asked whether a different lane was available. I do not say that to mock wage earners. I respect them. Many of them are working harder than the person with the side business and better advisor, but respect does not change arithmetic. If you live only inside the wage earner sequence, you are usually giving up planning lanes that business owners, investors, and more system-minded households can use. This is why I often tell younger people not merely to save more, but to build legitimate side income sooner than they think they need to. Not because every side hustle becomes a fortune, most do not, but because the existence of real trade or busyness activity can change the landscape of your financial life. It gives you another tax language, another legal identity for certain cash flows, another framework for turning some after-tax expenses into deductible or tax, advantaged items when the facts honestly support that move. That is not a loophole. That is adulthood. But adulthood also requires boundaries, and I want to be direct about that. There is a tremendous amount of low-grade tax fraud marketed online as entrepreneurship. Fake home offices, personal cars, disguised as fleet assets, sham board meetings in vacation resorts, children employed to do nothing, meals with no business connection, education with no real qualifying relationship to the business, outrageous depreciation claims without factual support. That garbage is not sophistication. It is short-term vanity that can become long-term pain. So let me draw the line as clearly as I know how. The goal is not to force personal life into business form. The goal is to identify the parts of your real economic life that truly belong in business or tax-favored form and structure them correctly. That distinction is everything. If you miss it, you become reckless. If you understand it, you become powerful. Now, I want to bring this to the final test because every serious framework needs one. Here is the mirror I want you to use. When you look at a large expense in your life, do not ask first, "Can I write this off?" That is the question of a hungry amateur. Ask these 5 questions instead. What legal lane does this expense actually belong in? If any, what business or tax-favored purpose does it genuinely serve? What structure or wrapper would have to exist for the best treatment to apply? What records would prove the treatment later? And if I had to defend this classification to a skeptical professional with no emotional investment in my happiness, would I still sound intelligent? If your answer to the last question is no, you are not looking at a deduction. You are looking at wishful thinking with paperwork that is not where I want you living. I want you living in the calmer and richer place where structure does the work, where the statement date is known, where the home office is actually exclusive, where the mileage log exists, where the HSA is funded intentionally, where the insurance premiums are captured correctly, where the education plan is lawful, where the child care lane is the right lane, not a fantasy lane, where meals are documented or not claimed, where the business is real enough that the tax treatment flows from substance, not from internet swagger. That is where real savings happen, not in one dramatic April year after year. Quietly, mathematically, before anyone outside your accountant, S-Office even knows what changed. And that is why I think the phrase, "write off everyday expenses," is both too crude and too weak. Too crude because it ignores the filters. Too weak because, once understood correctly, the real lesson is much bigger. The lesson is not that you can sometimes deduct a home office, a vehicle percentage, a meal percentage, an insurance premium, or an education reimbursement. The lesson is that the tax code is a map of categories, and if you learn to live with lawful structure instead of accidental leakage, you can move through life keeping more of what you earn without becoming dishonest, theatrical, or foolish. That is one of the closest things to an enduring edge I know. Not because it feels exciting, because it keeps working. And in money, the things that keep working quietly are usually the ones worth building your life around.